right, so today we're going to talk about the U.S. trade deficit, but there's a couple of important factors that lay into this that lead to a big trade deficit, and we'll focus on a couple countries and the relative strength of their currency and the average income to paint this whole picture of the U.S. trade deficit with another country. So the first thing we need to understand is comparative advantage. It says a country does something with the lowest opportunity cost. So from a very micro scale, let's just think of Florida or Georgia. So Florida oranges, Georgia peaches, Tennessee tobacco, Tennessee whiskey. These states have a comparative advantage in producing those goods. Other states cannot produce them. Minnesota can't produce Georgia peaches or Florida oranges. So that's what comparative advantage is. It basically says you do what you're good at and you specialize in that good. So from a big macro scale, countries export the good that they're good at, and countries import the good that they're not good at. So from a United States perspective, we have what we call a capital advantage. We have the #1 in the world in patents per capita, very highly educated economy. One of our biggest exports is actually universities. A lot of students from around the world come to the United States for an education, but other countries specialize in what we call labor-intensive goods. So you have the United States with the capital-intensive goods and other countries labor-intensive goods. So for example, we'll import goods that are cheaply made in other countries such as Mexico, China, Vietnam, India. Those types of goods we import, but they buy some of our capital-extensive goods, or they send their children to the United States for an education. So let's focus more in particular on our trade deficit with Vietnam. So there's a couple important things here that lead to Vietnam's specialization in their goods. First, they're a labor-intensive country. It's very cheap to make products there. If you look at their major exports to the United States, it includes furniture or putting together furniture. You probably wouldn't want to make that here in the United States. Another one is the fig plant. The fig plant is the rubber plant, aka they produce tires. So a lot of exports go to the United States that have to do with rubber, and especially tires that go on our cars. The trade deficit with Vietnam, America bought $136 billion worth of goods from Vietnam. They only bought $11 billion in the United States, which brings up another point. Their currency and average median income in US dollars per month for a Vietnamese person is $500 a month. So what good from America are they going to buy that they can't breach that threshold and they have to pay rent and other things? There's not a lot. So if you look at the $11 billion that they buy to the United States, it's probably, more government provided funds, maybe jets, airplanes, things of that nature. So we end up with, in Vietnam to the United States, $124 billion trade deficit. The trade deficit is basically we import more from Vietnam than we export to them. Since 1999, this has been a linear trend. Trade deficits with Vietnam, trade deficit with Vietnam. And a major reason why is that comparative advantage and the specialization of labor and the exchange rate in currencies and their average income. The US dollar to the Vietnamese dong is roughly 0.000038. 100 US dollars is 2 million Vietnamese dong. So due to exchange rates, comparative advantage, and labor specialization versus capital specialization, we see these massive trade deficits with Vietnam.